Interest rates. They might seem like just another number in the vast sea of financial jargon, but they hold immense power over the housing market. They sound boring, but trust me, they're a big deal, especially when you're buying a home. Imagine you're a first-time home buyer, excitedly browsing through listings, dreaming of your perfect home. Think of interest rates like the price tag on money. Just as you wouldn't ignore the price tag on a house, you shouldn't overlook the interest rate on your mortgage. When you borrow money for a mortgage, the interest rate is what you pay to use that money. It's the cost of borrowing, and it can significantly impact your financial future. Here's the catch: higher interest rates mean you pay more for your loan. This isn't just a small increase, it can add up to thousands of dollars over the life of your mortgage. That translates to bigger monthly payments and more money out of your pocket over the life of your mortgage. Imagine the stress of seeing those bills each month, knowing that a significant portion of your income is going towards interest. Lower interest rates, on the other hand, make borrowing cheaper. This can be a game changer for many families, making home ownership more accessible and less financially burdensome. This can fuel demand in the housing market, pushing prices up. When borrowing is cheaper, more people can afford to buy homes, leading to increased competition and higher home prices. It's a delicate dance between affordability and market forces. The balance between interest rates and home prices is crucial for maintaining a healthy housing market. So, before you jump into the housing market, understand how interest rates work. Educate yourself on current rates, historical trends, and how they might change in the future. They're the puppet master pulling the strings, influencing everything from affordability to home values. By understanding their role, you can make more informed decisions and navigate the housing market with confidence. Interest rates don't just affect your monthly payments, they also impact the overall cost of your home. A small change in the rate can mean a big difference in what you end up paying. For instance, a 1% increase in interest rates can add hundreds of dollars to your monthly payment and tens of thousands over the life of the loan. It's essential to consider these factors when planning your budget. On the flip side, lower interest rates can make your dream home more attainable. They reduce the cost of borrowing, allowing you to afford a better home or save money for other expenses. Historically, interest rates have fluctuated based on economic conditions, government policies, and market demand. Keeping an eye on these trends can help you time your home purchase for the best rates. Working with a knowledgeable mortgage broker can also be beneficial. They can help you understand the different loan options available and find the best interest rates for your situation. Remember, the interest rate isn't the only factor to consider. Look at the loan terms, fees, and other costs associated with the mortgage. A lower rate with high fees might not be the best deal. By taking the time to understand interest rates and how they affect your mortgage, you can make more informed decisions and achieve your home ownership goals with confidence. In summary, interest rates are a critical component of the housing market. They influence everything from your monthly payments to the overall cost of your home. By staying informed and working with professionals, you can navigate the complexities of the housing market and make the best decisions for your financial future. So remember, interest rates are the puppet master pulling the strings. Understand their role and you'll be better equipped to handle the ups and downs of the housing market. With the right knowledge and preparation, you can turn the dream of home ownership into a reality, no matter what the interest rates are doing. Let's get real about the impact of interest rates. They might seem like just numbers on a page, but they have a profound effect on your financial life, especially when it comes to big-ticket items like buying a home. Imagine you're eyeing a $300,000 house. It's your dream home, the one you've been saving up for, and you can already picture yourself living there. With a 20% down payment, you're borrowing $240,000. This is a significant amount, and the interest rate on your mortgage will determine how much you end up paying over the life of the loan. Now let's play with interest rates, because even a small change can make a big difference. Scenario 1, low rate 4%. This is a relatively favorable rate, and it means your monthly payments will be more manageable. Your monthly principal and interest payment would be around $1,146. This is a comfortable amount for many families, allowing them to budget for other expenses. Scenario 2, high rate 7%. This is a much higher rate, and it can significantly impact your monthly budget. That same house with the same down payment now costs you about $1,600 per month. This is a substantial increase, and it can strain your finances. That's a difference of almost $454 every single month. Over time, this adds up to a significant amount of money. Over 30 years, that's over $163,000 in extra interest payments. Ouch! This is money that could have been used for other important things, like saving for retirement or paying for your children's education. Interest rates directly impact how much house you can afford. When rates are low, you can afford a more expensive home. When rates are high, you might have to settle for something less. Even a small difference in the rate can significantly change your monthly payment and the total cost of your loan. For example, a 0.5% increase might not seem like much, but it can add up to thousands of dollars over the life of the loan. So pay attention to those rates. They are more than just numbers. They are a crucial factor in your financial well-being. Make sure to shop around for the best rates and consider locking in a rate if you think they might go up. Your future self will thank you. To understand where we are today, let's take a trip down memory lane. Back in the 1980s, interest rates were sky high, reaching double digits. Imagine getting a mortgage at 18%. Those high rates made home ownership a distant dream for many. But as rates gradually declined over the decades, more people could afford to buy. This increased demand, pushing home prices upward. We've seen periods of low rates fueling housing booms, followed by periods of rising rates leading to market cool-downs. Understanding these historical trends helps us make sense of today's market and anticipate potential future shifts. Fast forward to recent years, and we've been on a wild ride. The economic landscape has been anything but stable, with rapid changes and unexpected turns. From the highs of a booming market to the lows of a global pandemic, the journey has been tumultuous. The COVID-19 pandemic threw everything out of whack. Businesses shuttered, streets emptied, and the world came to a standstill. The economic impact was immediate and severe, affecting every sector and every individual. To stimulate the economy, the Federal Reserve slashed interest rates to near historic lows in 2020 and 2021. These unprecedented measures were aimed at encouraging borrowing and spending, hoping to jumpstart the stalled economy. These low rates, combined with other factors like limited housing inventory, led to a surge in demand and skyrocketing home prices. Home buyers, eager to take advantage of the favorable borrowing conditions, flooded the market, driving prices to new heights. Buyers were clamoring to lock in those low rates. The frenzy was palpable, with bidding wars becoming the norm and homes selling at record speeds. It was a seller's market and everyone wanted a piece of the action. However, as inflation soared, the Fed started raising interest rates aggressively in 2022 and 2023. The goal was to cool down the overheated economy and curb rising prices, but the impact on the housing market was immediate. This cooled down the market. The once hot housing sector began to show signs of slowing, with fewer buyers able to afford the higher mortgage payments. Open houses that were once packed with potential buyers now stood empty. Higher rates made mortgages more expensive, causing some buyers to hit the pause button. The dream of homeownership became more elusive for many as monthly payments soared and affordability plummeted. The relationship between interest rates and home prices is complex. While higher rates generally slow down price growth, other factors like supply and demand also play a role. The housing market is influenced by a myriad of elements, from economic policies to demographic shifts. While higher rates generally slow down price growth, other factors like supply and demand also play a role. The housing market is a delicate balance of various forces, and predicting its future requires careful consideration of all these elements. As we move forward, the interplay between interest rates, economic conditions, and market dynamics will continue to shape the landscape of home ownership.